Hello friends, welcome back to JK Shah classes. I am Professor Nihit Jhaveri. Today we will be continuing with the revision of PGBP chapter Profits and Gains of Business and Profession for CA Final AY 2025-26. We are done with two parts of PGBP chapter. Today will be the last part, third part and the last part. Today we have to discuss from presumptive taxation scheme and onwards, the last few pages. Last time we discussed about composite income from agricultural activity and non-agricultural activity. Now as far as presumptive taxation schemes are concerned, we know pretty well there are three sections for residents, 44 AD, 44 ADA and 44 AE, and there were four sections. Now one section is newly introduced for non-residents. As far as non-residents and foreign companies are concerned, we have 44B, 44BB, 44BBA and 44BBB. These four sections were there. From AY 25-26, Nirmala Sitharamanji has introduced one more section, 44BBC. So 5 sections for non-resident and 3 sections for residents. It would be incorrect to say that 3 sections for residents, because last section 44AE, which is for transporters, is applicable to resident and non-resident everyone. So this section is common between resident and non-resident. These two sections 44 AD, ADA are only for residents, and these 5 sections are only for non-residents or foreign companies. So starting with 44 AD, 44 AD has always been an important section. Whether assessee opts for the new tax regime or the old tax regime, this section can play a very important role. This is a beneficial section applicable to those who are carrying on business. However, who is the eligible assessee for this beneficial scheme and who is the non-eligible assessee? That's what we need to discuss first. There are some parameters. Eligible assessee will be resident, individual, HUF and partnership firm, but partnership firm other than LLP. Remember, resident person should be resident plus individual HUF or a partnership firm. Firm does not include LLP here, though the firm includes LLP. This section is not applicable to companies. Secondly, non-eligible. Who will be non-eligible? 3 types of persons will be non-eligible. Person who is carrying on agency business, or person who is earning income by way of commission or a brokerage, or the person who is carrying on any of the 11 notified professions, because for 11 notified professions we have section 44 ADA, next section or next presumptive taxation scheme, therefore not eligible for 44 AD. Here applicable only to businessman, person who is carrying on business being resident, individual, HUF or partnership firm. Which business? Answer: any business other than the business referred to in section 44 AE, transport business, because for transport business we have a separate section where the income, that is presumed income, will be calculated as per provisions of 44 AE. Now here there is one more condition, that the turnover or the gross receipt from such business should not exceed particular amount. Earlier the limit was 60 lakhs and blah blah blah. Now the limit is enhanced to 2 crore rupees. Turnover from such business should not exceed 2 crore rupees. However, instead of 2 crore, the limit will be 3 crore if one condition is satisfied. What is that condition? Condition is that cash receipts should not exceed 5% of the turnover with effect from AY 24-25, from which year that is immaterial. Instead of 2 crore rupees, the upper limit, the limit will be 3 crore. The turnover should not exceed 3 crore in order to be eligible for this section. If the cash receipts during the previous year do not exceed 5% of the turnover or the gross receipt of the current year. Remember 44 AB. In 44 AB, clause A, for business class person, the turnover for audit, tax audit, the turnover exceeds 1 crore, then tax audit is applicable. Instead of 1 crore, limit would be 10 crore. If limit will be 10 crore, if what? If cash receipts do not exceed 5% of the total receipt. Do not exceed 5% of total receipts. Remember that. Plus there is one more condition, cash payment should not exceed 5% of total payments. However, for 44 AB clause 1, there is a different condition. It should not exceed cash receipt should not exceed 5% of total receipt, and here plus cash payment should not exceed 5% of total payments. However, as far as 44 AD is concerned, the conditions are slightly different. Turnover should not exceed 2 crore, otherwise assessee will not be eligible. Instead of 2 crore, the limit will be 3 crore. There is only one condition, that cash received should not exceed. There is no condition with regards to cash payment. There is no condition with regards to payment. Condition is only with regards to receipt in order to be eligible for 44AD with a turnover exceeding 2 crore but up to 3 crore. If cash receipts do not exceed 5%, but here it is not same as this language used in 44AB. 44AB says cash received should not exceed 5% of total receipt. Here it says it should not exceed 5% of turnover or sales or the gross receipt and not the total receipts. There is a difference in the language. Okay. We have one practical question based on this particular point in the upcoming chapter, tax, audit and ethical compliance. I have recorded a separate video for that. Please have a look at it. There is a practical question based on this, asked by institute only, but not asked in the exam, asked in the module. Okay. So turnover does not exceed, cash receipts do not exceed 5% of total turnover of the current year, then in that case limit will be 3 crore. Okay. However, second proviso says that amount received by check or a draft, if it is not account pay, then it will be deemed to be cash receipt. So that be careful. Same condition was there or same proviso was there for 44AB also. How much will be the income? Income will be depending on the amount of turnover is received by way of account pay check, account pay draft, ECS or other prescribed electronic mode, or received by way of cash or bearer check or cross check. That much turnover which is received by account pay banking channel, account pay check, account pay draft, ECS or prescribed electronic mode, on that income will be deemed to be 6% of that much sales, and on the balance sales it will be 8%. What will happen in case the turnover is not received till the year ending or not received till the due date of filing IT return? Answer, if that much turnover which is yet to be received till the due date of filing IT return and assessee is following accrual system, then on that much turnover which is not received, apply 8% provided not received up to the end of the previous year. So 6% will be applied only on that much turnover, that much sales gross receipt turnover which is received as on the due date of filing IT return, on or before the date of filing IT return or on or before the due date of filing IT return, whichever is earlier, by way of account pay check, account pay draft or through other prescribed electronic mode including ECS, then you apply 6%, otherwise you by default apply 8%. So that much turnover which is received after the due date of filing IT return but taken into account in the current year under accrual system of accounting, then on that much turnover which is not received you apply 8%, though it may later on be received by way of account pay check, then also you cannot take the advantage of 6%, or the sum higher than 6%, 8% claimed to have been earned by assessee. Now here government has not clarified properly. Government simply says either 6%, 8% or the sums actually claimed to have been earned by assessee. Actually claim to have been earned by assessee, meaning thereby assessee himself claims it, then it's okay. Otherwise by default 6%, 8% of the turnover. It does not say 6%, 8% of turnover presumed income versus higher income, whichever is higher. That is not the language used. Unlike 44AE transporters, where it is very clearly stated presumed income or the actual income, whichever is higher. Here it does not say whichever is higher, it says whichever assessee wants to declare, provided actual income should be higher than the sum of 6%, 8%. From this total income, what will be allowed and what will not be allowed, that is our next point, which is an important point. 4 things will not be allowed. Number 1, no further deduction for any actual expenditure between section 30 to section 43B. Section 30 to section 43B would include depreciation also, because depreciation is governed by section 32. Depreciation of current year will not be allowed, which I have covered separately also. No depreciation will be allowed because depreciation is governed by section 32 and section 32 falls between section 30 to section 43B. Then no deduction will be allowed under chapter 6A, but please read the whole sentence entirely. No deduction, it does not say no deduction under chapter 6A, it says no deduction under chapter 6A under heading C, which is ATIA, IAB, IAC, ATIB, IBA, ATIC, ID, IE, ATJJA, JJAA, ATP, ATQQB, ATRRB. Other deductions under chapter 6A like ATC, LIC PPF, Mediclaim, ATD, donations, ATG, they all will be allowed. Everything will be allowed, only under heading C will not be allowed, which are profit linked deduction. 10AA will not be allowed, SEZ. We have a separate recording or separate video on only section 10AA already uploaded. You can have a look at it. These 4 items will not be allowed. No actual expenditure including depreciation, no 10AA, no chapter 6A. These benefits will not be allowed. But what does that mean? That means on the right hand side, this particular box is in the form of interpretation. This is given in the act in section 4480 that these 4 items will not be allowed. Actually 3 items, depreciation is already covered in point number 1. So 3 items not allowed, which means that 3 remaining items appearing on the right hand side table will be allowed. Basic exemption limit will be allowed if the assessee is individual or HUF. Who all are eligible? Individual, HUF and partnership firm, 3 people are eligible. Out of them, basic exemption is allowed only to individuals and HUF, whether under new tax regime or the old tax regime. Exemption under section 10 will be allowed. 10AA not allowed. Section 10 is not prohibited. Only section 10 is allowed. And set off of brought forward losses under section 72 will be allowed. Set off of brought forward losses within the allowable parameter, because what is prohibited is between section 30 to 43B, and brought forward losses fall under section 72. Section 72 is outside section 30 to 43B, therefore brought forward losses are allowed. However, one type of brought forward loss, which is called unabsorbed depreciation, will not be allowed. Brought forward unabsorbed depreciation will not be allowed because it is governed by section 32 subsection 2, which falls between section 30 to section 43B, therefore not allowed. Clear? Remember this is an important point. The remaining things anybody can calculate. Books of accounts will not be required to be maintained naturally, therefore audit also will not be required in case person declaring as per 44 AD. However, as per 44 AD subsection 4, which was amended by Arun Jaitley ji few years back, now he passed away. Whatever amendment Arun Jaitley ji carried out is creating so much of confusion in real life. Everyone is confused, but I will remove that confusion. It says that once 44 AD is opted for, once eligible assessee, first of all assessee should be eligible. Eligible means he should be resident during the current year, plus he should be individual, HUF or a partnership firm other than LLP, plus turnover should not exceed, from the given business, turnover should not exceed 2 crore rupees, or condition satisfied, then turnover should not exceed 3 crore rupees. If these 3 conditions are satisfied, then the person is eligible assessee. If he is eligible and he opts for once he opts for 44 AD in any previous year, then next 5 years, understand whatever we are discussing is applicable only when assessee once opts for 44 AD. Means up till now he had been declaring his income not as per 44 AD, he had been always declaring his actual income only. Then this 44 AD subsection 4 is not applicable. 44 AD subsection 4 becomes applicable only when assessee once opts for 44 AD. That means declares his income as per 6%, 8% of the turnover. Once he opts for 44 AD, next 5 years he will have to opt for section 44 AD and declare his income to be minimum 6%, 8% of the turnover or the actual income, whichever is higher. In case he doesn't do that in any of the next 5 years, simply we can say there will be lock-in of next 5 years. In case he does not declare income as per 44 AD in any of the next 5 years after once opting for this section, then the year in which he does not opt, next 5 years he will not be allowed to opt. Understand? Year 1 he did not opt for 44 AD, year 2 also he did not opt, year 3 also he did not opt, year 4 also he did not opt, year 5 he opted for 44 AD for the first time. He opted for 44 AD, that means he declared his income to be minimum 6%, 8% of turnover. Once he declares in any of the year, next 5 years he will be locked in 6, 7, 8, 9, 10. Next 5 years he has to declare as per 44 AD. Suppose in his 6th year he did declare, 7th year also he declared, 8th year he did not declare as per 44 AD. That means he declared his actual income and the actual income is less than 6%, 8% of turnover. Then the moment he does not declare as per 44 AD, next 5 years, that is 9th, 10th, 11th, 12th, 13th. Next 5 years he will not be allowed. Even if he wishes to, he cannot. What does this mean? This means that for the next 5 years he has to declare his actual income only, and In these 5 years, then what is the punishment then? What is the punishment? Suppose in the next 5 years actual income is less than 6%, 8%. That is what assessee wanted and government is officially allowing it. A government is compelling him to do something which he wanted to do. Answer, no, it's not that way. Here these 5 years, you can say once he opts, then there will be lock-in for the next 5 years, 6, 7, 8, 9, 10. Till 10th year he has to opt for this section. 5 years lock-in, and he violates or does not opt in any of the year, 8th year, then next 5 years there will be lockout. But what is the punishment? This is what assessee wanted. So it's not a punishment actually. Answer, it is a punishment. Why? Because for these 5 years of lockout period, so he will be called as governed by section 44AD subsection 4, or assessee will be called as referred to in section 44AD subsection 4. These 5 years, if total income exceeds basic exemption, then he has to compulsorily get them audited, compulsorily get his books of accounts audited. Audit of books of accounts will become mandatory. Even if he does not wish to, even if his turnover is below 1 crore, below 10 crore, below 2 crore, below 3 crore, come what may be, he has to get the books of accounts audited provided total income exceeds basic exemption. Whether he declares income to be 6%, 8%, less than that, more than that, come what may be, total income is more than basic exemption limit of 2.5 lakh under old tax regime or 4 lakh rupees under new tax regime, then books of accounts will have to be audited compulsorily. That is what is the punishment. So in case he does not want to incur expenditure of audit, then he has to keep on declaring income as per 44AD. However, this is applicable only when he once declares as per 44AD. Does not declare, then this rule is not applicable. Keep on declaring actual income, keep on declaring income to be 3% of turnover, 4% of turnover, 2% of turnover, come what may be, no audit will be required in these first few years unless turnover exceeds 2 crore or 3 crore rupees. If the turnover exceeds the limit given in section 44AD, the upper limit is 2 crore and 3 crore. If the turnover exceeds 2 crore, 3 crore, then he is not eligible only for 44AD. If he is not eligible, then this section 44AD subsection 4 does not apply only. 44AD subsection 4 becomes attracted or will be applied only when assessee is eligible for 44AD. And assessee has once opted for 44AD, then only 44AD subsection 4 will be attracted. So simple language, 44AD subsection 4 will be attracted only once assessee has opted for 44AD in any of the year. Opted for 44AD means declared income as per 44AD. Declared income as per section 44AD means declared income to be 6%, 8% of turnover. Second thing, once he opts for 44AD, once he declares his income as per 44AD, the next 5 years he has to declare as per 44AD only. That means 6%, 8% of turnover or higher than 6%, 8%. In case he does not declare in any of the next 5 years, then the year in which he does not declare, next 5 years there will be lockout. He will not be allowed to opt for 44AD, will not be allowed to declare income to be 6%, 8%. And in addition to lockout, fourth condition, audit will become mandatory provided total income exceeds basic exemption limit in those 5 years, any of those 5 years, provided he is eligible to opt for 44AD in those 5 years. In case he does not become eligible, in case he becomes non-resident, that's why he is not eligible, then this audit will not be attracted. Simple. Whatever we are discussing is under an assumption that all these years, year 5, 6, 7, 8, 9, 10, 11, 12, 13, all these years he was an eligible assessee. If he is eligible, then only section will be attracted, then only 44AD subsection 4 will be attracted. So I am reading it out, it is an important section, keep it in your mind, it will help you for sure in the real life. Once an eligible assessee declares his profit as per 44AD subsection 1 in any previous year, that means declares income to be 6% or 8% of turnover, but then he does not declare his profits as per 44AD in any of the subsequent 5 years, then he will not be allowed to claim the benefit of 44AD for the next 5 succeeding previous years following the previous year in which income was not computed as per 44AD subsection 1. Where is it given that audit will be mandatory? Answer, audit will be mandatory, that is given in 44AD subsection 5, says if 44AD subsection 4 becomes applicable. When will it become applicable? 44 AD subsection 4 becomes applicable means assessee has now come under lockout period of 5 years and the total income exceeds basic exemption limit during those 5 years, then if he is eligible during those 5 years, he will be required to maintain books of account, plus he will have to get the books of accounts audited and furnish audit report, provided total income exceeds basic exemption. Where is that given? That is given in 44 AD, 44 AB. 44 AB, if you recollect, point number E. 44 AB, point number E. Point number E, assessee covered by 44 AD subsection 4 declaring his actual income to be less than presumed income and total income exceeds basic exemption limit. Okay, so audit will become attracted, that is the punishment. Now proceeding further, 44 AD is over. Interesting section and important section. Of course, still confusions remain because Arun Jaitley ji is no more there to answer any of the questions. He passed away, and when he introduced this subsection 4, at that time people did not question him, and now he is no more there to answer anybody's question. 44 ADA, again an important section. 44 AD is also important. This section is also important. 44 ADA. This is applicable to professional people, but not for all professions. It is applicable only to 11 notified professions. Secondly, it is applicable only to resident individuals and resident partnership firms other than LLP. Two people, but should be resident individual or resident partnership firm other than LLP. 44 AD was applicable to 3 people, resident individual, HUF and firm. This section does not apply to HUF because HUF cannot carry on these 11 professions. Chartered accountancy, company secretary, HUF cannot. Only individuals can do or partnership firms. But LLP, why LLPs are excluded? Nobody knows. LLP should have also been covered, but doesn't matter. Resident individual partnership firm carrying on any of the 11 notified professions and the gross receipt from such profession does not exceed 50 lakh rupees. Instead of 50 lakh, limit will be 75 lakhs if condition is satisfied. Same condition what we discussed for 44 AB. For 44 AB, limit of turnover is 2 crore. Instead of 2 crore, it will be 3 crore if conditions fulfill. Here the limit is 50 lakhs for gross receipt from profession. Instead of 50 lakhs, limit will be 75 lakhs if some conditions are satisfied in order to become eligible. Or gross receipt from profession do not exceed 75 lakh if the cash receipts during the previous year do not exceed 5% of gross receipts during the previous year. Though it says do not exceed 5% of total gross receipts, here we mean to say professional gross receipts. And again same proviso, second proviso, just like 44 AB, in case if the payment is received by check or a draft which is not an account payee, will be deemed to be received in cash and accordingly will be treated at par with cash received. Unlike 44 AB, here there is no bifurcation 6%, 8%, nothing like it. Here only 1%, 50%, 50. Income will be 50% of gross receipt from such profession. However, which 11 professions are notified professions out here? Only notified professionals are covered here. Accountancy, profession of medicine, law, accountancy, architecture, interior decoration, authorized representative, film artist, engineering, company secretary, technical consultancy or information technology, IT. These professions can be carried on, some of these professions can be carried out by company also, like information technology, architecture, interior decoration, all these can be carried on by company also, but companies are not eligible neither for 44 AB neither for 44 AD nor for 44 ADA. Okay. And last point, the income so computed 50% of gross receipt shall be subjected to following restrictions. Following restrictions or following relaxation, 2 conditions or 2 restrictions. Number 1, this income will be final income. No further deduction will be allowed for any expenditure referred to in section 30 to section 43B, including depreciation and including brought forward unabsorbed depreciation, and no depreciation will be allowed. Depreciation is a part of point 1. Whatever restrictions, there were 2 extra restrictions here in 44 AD. Which 2 extra restrictions? No deduction under chapter 6A and no 10AA. Similar restrictions do not find a place out here in 44 ADA. Here there is no restriction with regards to chapter 6A deduction, chapter 6A heading C, and there is no restriction with regards to 10AA. Why? Because 10AA and chapter 6A heading C are possible only for business income, not possible for professional incomes. Professional people are not eligible for any of these sections of chapter 6A heading C. Understand, we are talking only about heading C, we are not talking about other headings. And 10AA, which is also applicable for export of goods manufactured in special economic zone, which is not applicable for professional services, so it's out of question. That's why there is no mention about disallowability of chapter 6A heading C deduction or disallowability of deduction under 10AA. On the other hand, basic exemption limit will be allowed if the assessee is individual or HUF, and set off or brought forward loss will also be allowed, because set off or brought forward loss is governed by section 72, which is not a part of section 30 to section 43B. It is a different section, therefore allowed. But other than unabsorbed depreciation brought forward, because unabsorbed depreciation brought forward is part of section 30 to section 43B. Now the third is section 44AE, which is applicable to resident as well as non-resident. It is applicable to any assessee irrespective of residential status. Individual HUF, AOP, BOI, companies can also opt for 44AE. Company, partnership firm, LLP also, HUF also, company also, anybody, provided for 44AD there is a condition, turnover should not exceed 2 crore or 3 crore rupees. 44ADA there is a condition that professional gross receipt should not exceed 50 lakh rupees. Here also there is a condition is that the number of goods carriages, number of vehicles, that is goods carriage, we call it as goods carriage, the number of goods carriage do not exceed 10 at any time during the previous year. But we are talking about which goods carriages, which are operated by the assessee or which are owned by the assessee. Answer, ownership is the condition. Assessee should not own more than 10 goods carriages. There is no upper limit with regards to number of goods carriages operated by the assessee. Assessee can operate say 5 trucks of its own and remaining 45 trucks taken on rent. Total 50 trucks are operated by assessee, no problem, assessee will be eligible. However, don't think much about it, because if he operates 50 trucks, out of 50 trucks 5 are owned by him, which fulfills the condition of maximum 10 owned by him, and remaining 45 are taken on rent, no problem. But this section will be applicable only on computing income from those goods carriages which are owned by the assessee. As far as remaining 45 are concerned which are taken on rent by assessee, as far as these 45 are concerned, what is taxable is actual income only. Actual income only. 44AE not applicable. 44AE not applicable. 44AE will be applicable only for those vehicles which are, or those goods carriages which are owned by the assessee. Okay, how much will be the income? For computing income, we divide the goods carriages into two categories, heavy and light. If it is heavy, what does heavy goods carriage mean? Means the unladen weight or gross vehicle weight or unladen weight, it is also called as unladen weight. Unladen weight exceeds 12,000 kilograms. 12,000 kilogram, or you can say exceeds 12 tons. 12 tons, and is up to 12 tons or up to 12,000 kilogram, then it will be called as light goods carriage vehicle. What is unladen weight or gross vehicle weight? Unladen or gross vehicle weight means the weight of the vehicle, the goods carriage, without goods loaded inside it. Without loading the goods, the empty vehicle, the weight of the empty vehicle is up to 12,000 kilogram, it will be light vehicle, and more than 12,000 kilogram, it will be heavy vehicle. If it is heavy vehicle, then income will be higher of the following two. If it is light vehicle, then also income will be higher of the following two. Number one, the presumed income, and number two, actual income. Actual income claimed to have been earned by assessee from such vehicle. Here also actual income, whichever is higher. So either presumed income or actual income, whichever is higher. Such kind of language does not find a place in section 44AD or 44ADA. In 44AD, 44ADA, assessee is allowed to declare presumed income without comparing with the actual income. In fact, assessee is even exempted from maintaining books of accounts and exempted from getting books of accounts audited also. But here it is not like that. Assessee will have to maintain books of accounts, will have to declare actual income or presumed income, whichever is higher. How much will be the presumed income from heavy vehicles? From heavy vehicles, it will be 1,000 rupee per month per vehicle, 1,000 per month per ton, per month per ton for the period during which goods carriage was owned by the assessee. Here the period of ownership is to be checked, period of ownership is to be seen, and not the period of actual operation. Say for example, vehicle was owned by the assessee all throughout the year, all the 12 months, but actually operated only for 11 months, So 1 month the vehicle was sent to garage for mechanical repairing or repairing of the inside tools. Whatever may be, ultimately it was operated for 11 months. Then also ownership period is 12 months. We have to consider ownership period and not the period of operation. 1000 per month per ton, 1000 per month per ton for the period during which the vehicle was owned by the assessee, or actual income, whichever is higher. On the other hand, for light vehicle, it is not per ton, it is per month only, 7500 per month. For heavy vehicle, 1000 rupee per month per ton. For light vehicle, 7500 per month. That's it. It is not per ton. Irrespective of the tonnages, of course, it should be up to 12 tons maximum. For the period of ownership, period for which goods carriage vehicle was owned by the assessee, ownership period to be considered, or actual income, whichever is higher. If assessee is a firm or LLP, then this is an extra point which many people are not aware of. Here there is a clarification which is different than what we studied in 44 AD or 44 ADA. In 44 AD or ADA, if assessee is a partnership firm, then also no deduction will be allowed for any section ranging between section 30 to section 43B. Here also same thing, except of deduction on account of payment of salary, commission, bonus, remuneration or interest to partners by partnership firm will be allowable under section 40 clause B. Whatever is allowable as per 40 clause B, that much will be allowed to be claimed if assessee is a partnership firm or LLP. Okay, this is something extra, this is unusual. Unfortunately, Arun Jaitley ji, the sections were already having different provisions and were creating confusion. Arun Jaitley ji not carrying out further amendment or not clarifying it has created further confusion. However, we will not blame any finance minister as such, because earlier finance minister could have also done it, Chidambaram also could have done it, Nirmala Sitharaman ji could have also done it, but none of them have done it, creating or leaving us with a lot of confusion. Okay, this is applicable only for 44 AE, only for 44 AE, not applicable for 44 AD and 44 ADA. So 44 AD, 44 ADA, firm cannot make or cannot claim deduction of payments made to partner with regards to salary, commission, bonus, remuneration or interest to partner, even if assessee is a firm or LLP, in 44 AD or ADA. But in 44 AE, firm will be allowed to claim the deduction subject to whatever is a limit prescribed in 40 clause B, which we already studied, for which we have a separate chapter also called assessment of partnership firm, which I have recorded a separate video for. You can have a look at it. Next title is the common points between all the three sections, 44 AD, AD, common points between section 44 AD, ADA and 44 AE. Number 1, sales, turnover or gross receipt for these three, especially for 44 AD, ADA, should not include any reimbursement. Reimbursement of out of pocket expense should not be taken into account as a gross receipt. However, there is no clarification about GST. There is no clarification about GST. I have written a letter by email to CBRT as well as by Finance Ministry. Supposingly my sales actually at cost is 100 lakhs, not at cost including profit, but I had to collect GST. I fall under 18% category. So 18 lakh I received from a customers 118 lakh, which is below 2 crore, which is below 200 lakh or up to 200 lakh, or it is up to 300 lakh also. So I am eligible or not? Answer, I am eligible. I am eligible for 44 AD, but 6%, 8%, whatever may be the percentage, to be applied on what? It should be applied on 118 or it should be applied on 100. This figure. That government needs to clarify. I have written an email to government to clarify this. And this matter I have discussed with various CITs and CCITs also, including retired CCIT, CIT. No one has been able to give me any satisfactory reply. In real life, what do? We apply this on 100 lakh only. And some people who are faking up everything, they will apply 6%, 8% on 118, because for them it doesn't matter. They go backwards. Some people who start from the bottom, that how much tax they want to have and how much refund they want to claim, they go backwards and they work out the percentage to be shown. In such situation, it doesn't matter whether you take percentage of 100 lakh or you take percentage of 118 lakh including GST. But otherwise, government needs to clarify. Second point, assessee may declare an income higher than the above income, higher than the presumed income. for 44 AD or ADA. For 44 AD, ADA, it is optional to declare higher income. But as far as 44 AE is concerned, assessee has to declare higher income only by default. Next point, if actual income is less than presumed income and assessee wants to declare actual income and the total income is more than basic exemption limit, then assessee will have to maintain books of accounts and get such books of accounts audited in 44 AD or ADA. However, for 44 AE, he has to declare higher income only. Lower income is out of question. For 44 AE, he cannot declare lower income. It is very clearly given whichever income is higher. But even for 44 AE also, assessee can maintain books, get them audited and declare lower income, actual income to be lower income. Then audit is mandatory. If he wants to declare for 44 AE, if assessee wants to declare actual income and the actual income is less than presumed income, then he has to compulsorily get the books of accounts audited. But as far as 44 AD and ADA are concerned, these two sections are concerned, there is one more condition apart from assessee wanting to declare actual income and actual income lower than presumed income. There is one more condition, total income should exceed basic exemption limit also. So as far as 44 AE is concerned, audit will be mandatory if assessee wants to declare actual income to be lower than the presumed income, even if total income does not exceed basic exemption limit. So to conclude the story, for 44 AD or 44 ADA, only two conditions. Condition 1, actual income is less than presumed income. Even for 44 AE also this condition has to be fulfilled. Second condition, assessee wants to declare actual income. These two are common conditions. Third condition, which I don't have space to write here, but I am just orally discussing. Third condition, which is applicable only for 44 AD and 44 ADA. Third condition is that total income should exceed basic exemption. That condition is only for 44 AD, ADA, not applicable for 44 AE. Right? Okay. However, these sections talk about how to compute income. How much will be the income? They do not talk about a tax rate. This is not a chapter on special rates of tax. This is a chapter of PGBP where it is clarified how to compute income from given business or given profession. Tax rate applicable will be whatever is a normal tax rate as is applicable to the given assessee during the year. Though no depreciation is allowed in all the three sections, then also WDV shall be reduced by notional depreciation every year. Keep on reducing notional depreciation. No deduction will be allowed for any expenditure from section 30 to 43B. Disallowance under 43B shall not apply to presumed income, meaning thereby payment to somebody without deducting TDS or without complying with TDS provision, then disallowance of 100% while paying to non-resident or 30% while paying to resident will not be attracted. Even 43B, 9 expenditures which are allowed to be deducted only when actually paid on or before the due date of filing IT return. Tax, duty, cess, fees, 3 types of payment of employees, 3 types of interest to scheduled bank, cooperative bank, public financial institution, state financial institution, state industrial investment corporation, etc. or interest to NBFC. All these interests, disallowance will not be attracted even if payment is not yet been made. And last, 44 AD, ADA, for these two sections, if you recollect, in advanced tax chapter we had discussed. I have recorded a video on advanced tax also separately. You can go and have a look at it. For 44 AD, ADA, advanced tax, normally there are 4 advanced tax installment due dates, or there are 4 types of installments, whereby first installment is the 15th day of the first quarter last month, April, May, June. First quarter is April, May, June, last month is June, 15th June is the first due date. There are 4 due dates applicable for a normal person, but for a person covered by 44 AD, declaring income as per 44 AD or as per 44 ADA, entire advance tax 100% payable by 15 March of the relevant previous year. This benefit is not available for those covered by 44 AE, it is only for those covered by 44 AD, ADA. Now the next 5 are presumptive taxation schemes for non-residents or foreign company. 5 section 44B, double B, BBA, BBB, BBC. BBC newly introduced from AY 25-26. Before we proceed further, let me clarify. 44AD and 44ADA are only for residents. Only for residents. 44AE is for everyone, are for residents as well as non-residents or foreign company. And as far as these 5 sections are concerned, 44B till 44 BBC newly introduced, they are applicable only to non-residents or a foreign company, not available to residents, available only to non-resident. How much, which is a section number, what is the nature of income, and how much will be deemed to be the income? Income will be particular percentage of the gross receipts attributable to Indian operations. Particular percentage of gross receipts attributable to or gross receipts connected with the Indian operations. First income or first section is 44B, shipping income, income from operating ships. Shipping business, business of operating ships, not manufacturing ships, only operating ships. However, new section is introduced from current year AY 25-26 called 44 BBC. So for the purpose of 44 BBC, they have mentioned it in bracket, other than cruise ships. Whatever I have mentioned in bold italic, that is the amendment of the current year. Other than cruise ships, because cruise ships income is covered by 44 BBC separate section. For a normal ship which carries passengers or goods also, income will be 7.5% of gross receipts attributable to Indian operations. Of course, no further deductions for any expenditure will be allowed therefrom. This will be the final income. All these 5 sections will be reproduced in a chapter called International Taxation, part of International Taxation, book number 4 in our regular course. It will be covered by a chapter called Special Provisions Applicable to Non-Residents or Foreign Company, for which I have already recorded video and uploaded it also. Kindly have a look at it. Income will be 7.5%. However, tax rates are not clarified. What will be the tax rate? Tax rate applicable will be the normal tax rate as are applicable to the assessee otherwise. For example, if assessee is a foreign company, gross receipts are 100 lakh from Indian operation, income then will be 7.5 lakh multiplied by whatever is the tax rate applicable. Till last year it was 40%. This year onwards it is 35% for foreign company. That was 44B. Let me jump to 44 BBC and finish it off rather than jumping to 44 double B. BBC newly introduced income from operating cruise ships, business of operating cruise ships or income from operating cruise ships, not manufacturing cruise ships. Income will be 20% of the gross receipts attributable to Indian operation. Tax rate will be normal. Income will be deemed to be this much. First income 44B, last income is 44 BBC. And one of the income in between is 44 BBA, income from business of operating airlines or aircraft, income will be 5% of the gross receipts attributable to Indian operations. 7.5%, 5%, 20%, whatever is the rate applicable, they are for calculating income. Okay, they are percentages of what? 7.5%, 5%, 20% of what? Answer, oh, not of the global receipts, but 5%, 7.5%, 20% of the gross receipts attributable to Indian operations, or 5% of gross receipts which is accruing arising in India. When to say that accruing arising in India? So for all the 3 sections combined together, 44B shipping business 7.5%, 44 BBA airline business here it is 5%. फिर से ले गाऊँ. So 44B, BBA, BBC. 44B means shipping income 7.5%, BBA means airline income 5%, and BBC means cruise ship like Titanic, income will be 20%. They talk only about income, they do not talk about tax rates. When can we apply the percentage? Only when given income is deemed to accrue or arise in India, or when the given income is attributable to Indian operation. When can we say applicable or attributable to Indian operation? When either of the 2 things is in India, place of receipt is in India, or place of receipt of money, that is fare, or the origination of journey is from India. Origination of journey is called by the name of carriage of goods, passengers, mail, livestock. Carriage of goods, passenger, mail, livestock is from India, originates from India, or journey begins from India. Originates means journey begins from India, then only either of these two things is in India, it will be taken into account. Let's talk about airline business, 44 BBA. My uncle stays at Japan. He keeps calling me that come to Japan, at least once you come. I said okay fine. I booked the ticket of Cathay Pacific airline company. Cathay Pacific received money from me in India. Money is received by them from India. Where does the journey begin from? Answer, journey also begins from India to Japan. Journey begins from India. Both the things are in India, then it is definitely income attributable to Indian operation. However, my uncle keeps calling me and I keep refusing, saying that uncle, ticket prices are very high, I cannot. I can't afford, I am a small person. Uncle says, don't worry, I will book the tickets online sitting in Japan. My uncle made payment to Cathay Pacific directly sitting in Japan. So Cathay Pacific is receiving money outside India. Though the journey begins from India, I am going to travel to Japan. I will be traveling from India to Japan. It will be deemed to be accruing arising in India or attributable to Indian operations. Third, if the money is received in India, supposing my son studies in USA and for some emergency situation in the family, I called up my son and I told him to come back to India for few days. He said, Papa, I am ready to come back. I have a vacation, but I don't have money to buy tickets. I said, don't worry, beta, I will pay the tickets. I will pay for tickets. Cathay Pacific people, I booked the tickets with. They received money from me in India. Though the journey begins from USA outside India, it will still be considered as income attributable to Indian operation. Only in last situation, it will not be considered as attributable to Indian operation, where the money is accruing also outside India, received also outside India, or place of origination of journey is also outside India. Place of receipt also outside India, place of origination of journey also outside India. Both are outside India. Then only it will be not deemed to accrue or arise in India. 44B, shipping business, one extra item which you need to remember, which is Institute's favorite point, demurrage charges. So gross receipt attributable to Indian operations shall include demurrage charges also, or handling charges or similar type of charges. That we know pretty well, that is okay. 44BB and BBB. So what we talked about in this table was only about 4 sections, 44B, BB, BBA, BBB, BBC. However, out of these 4, we recently talked about 44B, 44BBA and 44BBC. When can we say that income is accruing arising in India? As far as 44BB and BBB is concerned, government says these people can declare actual income. It shall be 10% of amount received receivable, whether in India or outside India. Something should be there in India. What should be there? Either place of receipt should be in India, or here also place of receipt should be in India or outside India. Place of receipt could be anything, could be in India, place of receipt could be outside India also. Place of receipt is immaterial for these two sections. What is relevant is for 44BB and BBB, what is relevant is the given activity from which income is earned. That given activity should take place in India. What is 44BB? Supplying of plant machinery on hire or providing services or facility to any Indian concern. Prospecting for means searching for extraction of or production of mineral oil in India. These activities should take place in India irrespective of where is the money received. Either place of receipt should be in India, or extraction should be in India, production should be in India, or prospecting should be for in India. Then only it will be considered as gross receipts attributable to Indian operations, and accordingly section will be attracted. Okay, no deduction will be allowed for any actual expenditure, but chapter 6A deduction will be applicable, including chapter 6A heading C. We are talking about 44BB and 44BBB. For these two sections, 44BB and BBB, actual income is allowed to be declared. Actual income could be less than presumed income, but what will be taken into account for the purpose of presumptive taxation scheme will be the income or the turnover attributable to Indian operations and not the global turnover. Attributable to Indian operation will be decided according to this table for 3 sections, 44B, here this one, 44B, BBA, BBA and 44BBC. What is left is 44B and 44BB and BBB. For 44 double B and triple B, it shall be irrespective of place of receipt of money, the given activity should be carried out in India, meaning thereby supplying plant machinery should be in India. And 44 triple B, 10% of amount received receivable, whether received receivable in India or outside India, on account of civil construction, erection, testing and commissioning of plant machinery, that should be in India. Something should be there in India, then only it can be called as gross receipts attributable to Indian operations. Okay, for these two sections some clarification was inserted last year that from the final presumed income, no set off will be allowed for any brought forward business loss under section 72 and brought forward unabsorbed depreciation under section 32(2). Brought forward items are allowed to be deducted for 44B, BBA and BBC, allowed for 44AD also, ADA also, AE also, everywhere allowed. Not allowed for these two sections, 44 double B and 44 triple B, introduced from last year. Keep it in your mind, this point is slightly important. Question is expected strongly on this particular point. Assessee covered by section 44 double B and triple B, if actual income is less than 10% of turnover, they can declare actual income in their IT return, provided books of accounts are maintained and audited by chartered accountant, then they can declare actual income. Minimum alternate tax will not apply to a foreign company which has only above mentioned incomes and no other income and declares PGBP income in accordance with 44B, double B, BBA, BBB. Clear? Now the next is definition of certain terminologies. Now certain terminologies which are used in this chapter are defined in section 43, one of the last section. It has 43 subsection 1 going till subsection 6, arranged in an alphabetical order. The first one, section 43(1), defines actual cost. What do you mean by actual cost? Actual cost of the asset. Actual cost is nothing but same as cost of acquisition. But in capital gain chapter we call it as cost of acquisition, here we call it as actual cost. Actual cost of the asset for the purpose of calculating depreciation in the first year or for the purpose of calculating additional depreciation in the first year. So the actual cost of the asset ideally would mean the purchase price of the asset plus any incidental expenses incurred like loading, unloading charges, transportation charges, repairing charges in case you are buying a second hand asset, etc. All incidental expenses, purchase price plus incidental expenses minus any part of the cost of the asset which is borne by some other person, including government. So if any government subsidy or grant is received, that is to be subtracted from the cost of the asset. It means the cost of the asset, that is purchase price of the asset plus all expenses which are incidental to the acquiring of the asset like transportation, loading, unloading, installation charges, etc. minus any part of the such cost which is borne by any other person or any authority directly or indirectly. However, the way there was a clarification for section 35 AD, similar kind of clarification is here also, that in case if the asset is acquired for let's say 100 lakh, out of which any part of the cost of acquisition of the asset, whether revenue or capital, if it is paid in cash exceeding 10,000 rupees in one single day to one single person, then that much part will be ignored and only balance amount will be taken into account. Whatever is paid by account payee check, account payee draft, ECS or through other prescribed electronic modes, PEM I call it as prescribed electronic mode, then that much will be taken into account. So though the asset is acquired for 100 lakh, in balance sheet 100 lakh will appear, but whatever is paid otherwise by way of account payee check, account payee draft, ECS or through a prescribed electronic mode, that is paid by cash, that much will have to be ignored if it exceeds 10,000 rupees and it is paid in one single day to one single person. Otherwise by way of account payee check so and so and it exceeds 10,000 rupees, whether it is revenue expenditure or capital expenditure incurred is for acquiring the asset, then such expenditure will be ignored for the purpose of calculating actual cost. Now this actual cost has got 16 explanations in 43(1) describing 16 different situations where the actual cost is to be computed in a different way. First situation, asset acquired for scientific R&D, this is very straightforward. Scientific R&D and the deduction is claimed under section 35, then the cost, that is actual cost, will become 0. However, it does not say will become 0, it says the actual cost will be the real actual cost, original actual cost minus deduction claim under section 35. Eventually it will become 0. But once upon a time, if you recollect, under section 35 weighted deduction was allowed. Expenditure is 100 rupee, but the deduction could be 100, 125, 150, 175 or 200 rupees. Then it could become negative also because of weighted deduction. Then it bracketed wordings used to say if it becomes negative, then ignore the negative figure. As of today, the bracketed wordings play no role, so you can delete them. Number 1, explanation 1a, that is second explanation, stock in trade converted into capital asset. If stock in trade, say I am into business of dealing in jewelry, jewelry is converted into capital asset, then in such situation, whatever is the FMV of the jewelry as on the date of conversion will be taken into account. FMV as on the date of conversion. Third, that is explanation number 2, asset received by way of gift or inheritance. If it is received by gift or inheritance by will, then the cost will not be equal to 0, cost will not even be FMV as on the date of receipt, but cost will be equal to cost to the previous owner. But wait, just like section 49(1) of capital gain chapter, cost will be same as cost to the previous owner, but it will be cost to the previous owner minus notional depreciation from the date of acquisition by previous owner till the date of acquisition by current owner. Actual cost to the previous owner minus notional depreciation from the date of acquisition by previous owner till the date of acquisition by assessee, assuming that this is the only asset in the entire block if it is forming part of block of assets. Third explanation, 3, 4 and 4a, these three are bit off the track. This is what needs explanation to understand them. It says if the asset is used by assessee, asset is used by previous person for his business profession, asset is owned by some other person other than assessee, used for business profession, and that person has been claiming depreciation. Now it is acquired by assessee by paying a price more than FMV. And the AO is satisfied that. Why would anyone pay more than FMV? Say asset was acquired for 100 lakh, now the by other person, now the WDV is 20 lakhs, but 20 lakh rupee worth of asset I am acquiring for 100 lakhs, much more than FMV. For the only objective is to claim depreciation on a higher value. The extra amount which I paid 80 lakh rupees, I would settle under the table in cash. In such situation, the cost of acquisition of such asset will not be equal to original actual cost or the cost for which I acquired, that is 100 lakh, but will be determined by AO with the previous approval of JCIT. So let's try to understand. Assessee is Mr. X, asset is acquired by another person Mr. Y in 1819 for 100 lakh rupees. Now in 24-25 WDV is 59.049 lakh, but assessee that an FMV is 60 lakhs, nearing to WDV. FMV and WDV are almost at par, almost same, 60 lakh rupees. Assessee acquires it for 100 lakh rupees. Why would assessee do that? So that he can claim depreciation on 100 lakh rupees instead of 60 lakh rupees. Why would anyone pay 40 lakh rupees extra just to claim extra depreciation? Answer, he is paying 40 lakh extra. That 40 lakh will come back to him in the form of cash. There will be under the table arrangement which cannot be described, which cannot be talked about in the act. In the Income Tax Act, government cannot say 40 lakhs is taken in cash because otherwise AO will have to prove that, which is not possible. So here cost of acquisition will not be 100 lakh, the actual cost will be determined by AO with the previous approval of JCIT. AO will determine the price having regard to FMV and also having regard to WDV. Clear? Okay. The next one, explanation number 4, is again on the same lines. Here what is happening is depreciable asset is owned by assessee, held by assessee himself for his business profession, and assessee has been claiming depreciation, but assessee acquired for 100 lakh, now the WDV has become say 8 lakh rupees, 100 lakh worth of asset, depreciated, now the WDV has come down to 8 lakh rupees. If assessee continues with that asset, he will be able to claim depreciation on 8 lakh rupees, the remaining WDV. However, assessee purposely sells it or transfers it or gifts it to somebody else who is closely connected with the assessee, and then same asset is reacquired back by assessee from the same person or some other person, routed through some other person at a higher value. So 8 lakh worth of asset, WDV is 8 lakh, I give it away to somebody for 8 lakhs only, and then I reacquire it back from the same person or some third person for 100 lakh rupees, so that I can claim depreciation on 100 lakh. Then in such situation, the actual cost will be equal to the original actual cost minus notional depreciation from the date of acquisition till the date assessee ceases to be the owner, notional depreciation till now, and that will give us the WDV 8 lakh rupees, or the amount at which assessee reacquired it, let us say 100 lakh he reacquired it for, whichever is lower will be the actual cost. So, I have an example for this also. Explanation 4. So, supposingly assessee owns that asset, assessee is Mr. X, he owns an asset held for business profession acquired in 1920 for 100 lakh. Now, the WDV is 65.61 lakh in financial year 23-24. Now, assessee sells it to Mr. Y, another person, for 65 lakhs. So, 65 lakhs worth of asset is sold for 65 lakh, resulting into no capital gain, and then assessee reacquires it back for 120 lakhs from the same person or maybe some other person. Assessee reacquires it back for 120 lakh so that he can claim depreciation on 120 lakh. Why would anyone pay 55 lakhs more? 120 lakhs he is paying, WDV was 65 lakh approximately. So, that means assessee is paying 55 lakhs more. Why anybody would pay 55 more? So, answer that 55 will be settled in cash under the table, which will not be recorded in books of account, but that cannot be talked about in the act. So, WDV of that asset before transferring was 65.61 lakh. Now, the actual cost for Mr. X will be lower of the following two, either WDV at the time when he ceases to be the owner, that is 65.61, or the amount which he paid to acquire it back, 120, whichever is lower, 65.61 lakh will be the WDV or will be the actual cost. Explanation 4a, on a similar lines, somebody else is using the asset for his business profession and has been claiming depreciation. Assessee purchases that asset from that other person at a higher price, and assessee gives it back to that person on lease. This is called purchase and lease back, but it is titled as sale and lease back. Depreciable asset held by assessee used by another person. Asset is held and used by another person other than assessee. Let us say Mr. Y is holding it for his business profession and depreciation is claimed by Mr. Y on it, is acquired by assessee Mr. X and leased back to him directly or through some other person indirectly. Then WDV will be the WDV of such asset in the hands of such other person at the time of transferring it to assessee. I have an example for this also. For example, assessee is Mr. X, other person is Mr. Y, he acquired the asset, he held it for his business profession, has been claiming depreciation, acquired it in 1920 for 100 lakh, now the WDV is 59.049. 59.049 lakh. Assessee Mr. X purchases this asset for 120 lakh and gives it back to Mr. Y on lease. Then actual cost for Mr. X will not be 120, the amount for which he acquired will be equal to 59.049, whatever was the WDV in the hands of Mr. Y at the time of transferring it to Mr. X. Okay, important is fifth one, building. This explanation is applicable only for building. Building used for personal purpose, that is any purpose other than business purpose or professional purpose, non-business purpose, and assessee introduces it in his business profession, then the cost of acquisition or the actual cost of that building will not be zero, will not be equal to FMV also, will be equal to original actual cost of the building minus notional depreciation from the date of acquisition till the date of introducing it in the business profession. Original actual cost, say 100 lakhs minus notional depreciation till date, from the date of acquisition till the date of introducing it in the business. However, this explanation is only for building. There is no clarification for other assets other than building. So, what to do for other than building? So, answer for other than building, consider original actual cost without subtracting notional depreciation. Do not consider it to be zero, will not even be equal to FMV as on the date of introducing it in the business, but will be equal to original actual cost without subtracting notional depreciation. Institute asked one question on this, and institute did not ask on building, institute asked it for some other asset. 6.1, that is explanation 6, asset transferred by holding company to its 100% wholly owned subsidiary company or vice versa, subsidiary to holding or holding to subsidiary. Actual cost for the recipient company, transferee company, will be same as actual cost for the transferor company. Here, whatever is the actual cost for the transferor company, same will become the actual cost for the transferee company. Okay. However, here we are talking about actual cost. Upcoming provisions will talk about depreciable assets WDV. If it is depreciable asset, then same situation, asset transfer by holding to subsidiary or subsidiary to holding, the WDV for the recipient company will be same as WDV for the predecessor company, transferor company, as on the date of transfer. Meaning thereby, here in the name of actual cost, we are talking about ideally non-depreciable asset, or we are talking about the asset in the first year, as if asset is just acquired. Okay, then explanation 7a, asset transfer by demerged company to resulting company in a scheme of demerger will be equal to, for the resulting company, the actual cost will be equal to, actual cost for transferee resulting company will be equal to actual cost for the transferor demerged company. Whatever was the cost for the demerged company, same will become the cost for resulting company. Eighth one is very important from exam perspective. Recently MCQ also came on this, and up till now two practical questions have come on this. Asset acquired by taking loan. Same thing is described in ICDS also, ICDS number 9. Same treatment is given in ICDS 9 also. Asset acquired by taking loan. Then some portion of the interest will have to be capitalized, will have to be added to the cost of the asset. How much interest? So interest from the date of taking the loan till the date the asset is put to use, that much will have to be capitalized, will have to be added to the actual cost of the asset. How to do it? Let's try to understand it. Let's say, for example, loan is taken for 1 crore rupees at the rate of 12% per annum. Loan is taken on 1st April 2024. 12% per annum, that is 1% per month. Let's keep it simple. Asset is acquired for 180 lakhs on 1st October 2024, but it is not put to use immediately. It is put to use after 2 months, put to use from 1st December 24. Asset is put to use. Then interest will start from the date of taking loan. Interest will start from 1st April 2024. Interest till the date of acquisition of the asset, interest will be for 6 months. But till the date of putting it to use, it will be for 8 months, 2 months extra. So for 6 months interest becomes 6 lakh rupees, and for 8 months interest will be 8 lakh rupees. So which interest to be taken into account? This is the key point. Interest starting from the date of acquisition, date of taking the loan, not till the date of acquiring the asset, but till the date the asset is put to use. Interest for 8 months will have to be capitalized, which is 8 lakh rupees. Cost of the asset is 180 lakh, out of which 100 lakh is the loan, 80 lakh is assessee's own money, plus 8 lakhs of interest you capitalize. Cost of the asset will be 188 lakhs. What about the remaining interest? Interest for the whole year will be at the rate of 12%. Interest will be 12 lakhs. Answer, out of 12 lakhs, 8 lakhs we are capitalizing. Remaining 4 lakhs balance will have to be claimed as an expense in the P&L. Total interest 12 lakh, 8 lakhs has been capitalized. Remaining 4 lakhs will be allowed as a business expenditure. Allowed under which section? Allowed under section 36 subsection 1 clause 3. Read with section 43B. If the loan is taken from public financial institution, scheduled bank, cooperative bank, then interest will have to be paid. Payment made, then only deduction will be allowed. Next is moderate credit or Senved credit. Sometimes when you purchase the asset for 100 lakhs, there is GST included or excise duty. Earlier times it was excise duty or customs duty. Say GST is included 18%. So amount paid to acquire the asset must have been 118 lakhs. So out of 118 lakhs paid, depreciation will be on what amount? So answer, depreciation will be on 118 minus any amount of GST for which credit is allowed. Credit is allowed, input tax credit for entire 18 lakh, then cost of that asset will be recorded to be 100 lakh. Depreciation will be allowed on 100 lakh. Such duty shall be reduced from the actual cost if included whenever credit is available. 10th point is important or very important. Subsidy, grant or reimbursement may be from government or may be from any person. Same as ICDS 7. What to do? So government grant or any part of the cost which is borne by some other person, paid by some other person, will have to be reduced from the actual cost, to be reduced from the actual cost of the asset. However, problem arises when the government grant is not for one particular asset, but the government grant is for the entire project. Then what to do? So for example, the cost of the entire project is 500 crore and the cost of the given asset is 100 crore. The cost of given asset 100 crore is what percentage of the cost of the project? In the cost of the project, it is constituting 20% of the total cost of the project. If the government subsidy is for the entire project, government subsidy supposingly is 200 crore, which is 40% of the entire project. Then you want to find out that out of 200 crore rupees, how much is for this particular asset? How much is for this particular asset? Here government subsidy is not for one particular asset, it is for the entire cost of the project. Then what to do? So answer, proportionate subsidy will have to be found out. In what proportion? So answer, two ways to find out. One is whatever is a percentage of subsidy, which is 40% of the cost of the project, it will be 40% of 100 crore, 40% of the cost of given asset, it will be 40 crore. Or alternatively, in the total project, total cost of the project, the cost of this asset is 20% as we calculated it here. Then out of total subsidy, the subsidy for this asset will be 20% of 200 crore. 20% of total subsidy of 200 crore. Again you will get the same answer, 40 crore. Whatever way you are comfortable, but logically in the act it says this is the formula given in explanation number 8. If possible, try to remember with the explanation number. Out of total subsidy, what is the proportion, or out of total cost of the project, what is the proportion of this particular asset for which we are trying to find out subsidy? 20%. Then 20% of 200 crore, 40 crore will be the subsidy pertaining to this asset. At what amount the actual cost will be recorded? Actual cost of that asset will be 100 crore, the actual cost, minus subsidy pertaining to, or proportionate subsidy pertaining to this asset, 40 crore, 60 crore will be the cost of this asset. Okay, now proceeding further, next is explanation 11. But before that, let me read this out. If the subsidy is not for the one particular asset, but it is for the entire project, then such subsidy shall proportionately be reduced from the actual cost in the proportion of the cost of such asset to the entire project. In the proportion of cost of such asset 100 crore to the cost of entire project 500 crore, answer is 20%. So 20% of the total government subsidy will be deemed to be pertaining to this asset. Explanation 11, 12, 13, asset acquired outside India and it is brought to India by non-resident and used in India for business profession. So in such situation what to do? It says that whatever is the original actual cost in foreign currency minus notional depreciation from the date of acquisition till the date of bringing it to India, minus notional depreciation from the date of acquiring the asset till the date of bringing it to India, minus notional depreciation. That's it. Whatever WDV you get, notional WDV, that becomes the actual cost of that asset in India. However, government needs to clarify what currency conversion rate to be applied and whether acquired in foreign currency for, let's say, $1 lakh, original cost should be converted into Indian rupees, or after claiming depreciation the notional WDV is to be converted into Indian rupees. So first you will claim notional depreciation and then the balance WDV is to be converted into Indian rupees, or the original cost to be converted into Indian rupees and then depreciation to be charged notionally on the Indian currency. What is to be done? That needs to be clarified by government. You will get two different answers. If you first convert and then claim notional depreciation, then you will have a different answer. And you first claim notional depreciation, thereafter you convert it into Indian rupees, then you will again get a different answer. Two different answers are possible. Government has not clarified in last so many years. Asset acquired under corporatization of recognized stock exchange. Corporatization means conversion into company. From AOP, converting it into a company is called as procedure of corporatization. All recognized stock exchanges in India were in the form of AOP, and now gradually, starting with Bombay Stock Exchange, they have started converting themselves into company. So on paper they are two different entities. One is AOP, which is the predecessor, second is company, which is the successor. Since they are two totally separate entities, therefore assets on paper will be transferred by AOP to company. Though it's same only, it was earlier Bombay Stock Exchange and now it is Bombay Stock Exchange Limited. Then also on paper, since they are both two separate entities, therefore we will have to calculate how much should be the actual cost in the hands of company receiving the asset. Actual cost will be equal to whatever would have been the actual cost had there been no such corporatization in the hands of recognized stock exchange. Explanation 13, asset in respect of which deduction under 35 AD is already allowed. This is very straightforward. Cost of acquisition or the actual cost of such asset will be nil automatically because 100% deduction is allowed. Then proviso to explanation 13. Explanation 13 we just discussed. Now proviso. You know what is proviso? Proviso means exception to the above, or there is some extra clarification. Proviso to explanation 13. Explanation 13 is for 35 AD, 14 specified businesses. This is applicable in case where the asset if you recollect, last session we had discussed 35 AD subsection 7A, 7B were introduced, that once the asset is acquired for specified business, it should be used for the next 8 years. From the year of acquisition, it shall be used for a period of 8 years for the same or some other specified business. Cannot be used for non-specified businesses. Can be used for another specified business, that is fine within 8-year period, but shall not be used for any non-specified business. If it is done, if it is violated, then what will happen? Violation takes place, let's say in year 3. In year 3, then what to do? Then whatever was the deduction claim will have to be reversed. Deduction claimed under section 35 AD. However, deduction claim under section 35 AD shall be reduced by notional depreciation for the completed years. If this violation takes place in year 3, that means completed years are only 2, year 1 and year 2. So for first 2 years, whatever would have been the depreciation, which we have not claimed because we were not allowed to claim, because we claimed 35 AD, we were not allowed to claim depreciation. So if depreciation would have been allowable or depreciation would have been claimed, in case where depreciation was claimed, which will be now called as notional depreciation, that much amount. So for example, deduction claim is 100 lakh, the actual cost of the asset, minus notional depreciation for year 1 would have been 10 lakh, notional depreciation for year 2 is 9 lakh under WDV system. Then in such situation, 81 lakh is to be reversed, deduction of 81 lakh to be reversed. Now the question is, now the asset is transferred, violated in year 3 means asset is transferred to non-specified business. Assessee starts using it for non-specified purposes. Then in such situation, under non-specified business, depreciation is allowable. Under section 35 AD, if acquired for specified business and deduction is claimed under 35 AD, then depreciation not allowed. But had it been acquired for non-specified business, then depreciation would have been allowable. Therefore, now for that other business, we'll have to find out cost. We'll have to find out actual cost under the other business. Actual cost under other business will be equal to same amount whatever is reversed under section 35 AD. That means deduction claim under 35 AD minus notional depreciation. Same thing we will write differently here. Here we will say original actual cost minus notional depreciation. Answer will be same, 81 lakhs. So it will be asset on which deduction was allowed under 35 AD ceases to be used for specified business and begins to be used for any other purpose other than specified business before expiry of 8 years period starting with the year of acquisition, and accordingly is deemed as income as per 35 AD subsection 7B. 81 lakhs is deemed as income. Then the cost of that asset for other business will be actual cost minus notional depreciation from the date of acquisition till the date of beginning to use it for other businesses. Next is definition of speculative transaction 43.5, which is important, but only some part is important. It says speculative transaction means a situation where buying and selling of commodity takes place, buying and selling of commodity including stocks and shares without making payment for purchase and without receiving sale price. The buying and selling transaction, opposite direction transaction, two transactions of opposite direction are squared off against each other, are settled, ultimately settled otherwise by way of actual delivery or actual transfer of the commodity or the scrips, that is called as speculative transaction. Many people are under a wrong impression that speculative transaction incomes are taxable at a specific rate, 30%, etc. No, there is no such specific rate. It is taxable as per normal rate. It will be considered as business income compulsorily, cannot be offered under the head IFOS, cannot be offered under the head capital gain also. It has to be offered under the head PGBP. That is one thing. Secondly, there is no specific rate of tax. It will be taxed as per normal income. Ideally, speculative transaction would mean, as far as stock markets are concerned, it would mean intraday transactions where there is no delivery taking place. While buying the shares, you don't get the delivery. While selling the shares, you don't have to give delivery. Ultimately, they are settled. That is called intraday transaction. However, proviso to 43.5 talks about 5 exceptions. In following 5 situations, given transaction will not be regarded as speculative transaction. What if it is regarded as speculative transaction? What will happen? Answer: nothing will happen. It's just that head of income will be PGBP, and in case of loss, then loss can be carried forward for 4 years only as compared to 8 years. and such loss from speculative transaction can be set off against same type of income only, cannot be set off against non-speculative profit. That is the only difference. Otherwise speculative loss, otherwise speculative profit, speculative loss, both are same as, exactly same as non-speculative profit or non-speculative loss. There is no difference between speculative and non-speculative. Only thing is that head of income will be this, and secondly it can be carried forward in case of loss, can be carried forward for 4 years as compared to 8 years, and thirdly it can be set off against same type of income only, homogeneous loss. 5 transactions will not be regarded as speculative transaction. First 3 are in the form of assessee entering into 2 types of transaction. Assessee is entering into a physical transaction, actual transaction of buying the commodity or selling the commodity, and assessee enters into opposite direction transaction in forward market or derivative market. A contract in respect of raw material or merchandise to guard against the loss through future price fluctuation in respect of contract for actual delivery, in respect of contract for actual delivery of goods. So in the actual delivery, if assessee is purchased, then in the forward market he will sell, so that in the when he receives actual delivery, in case of actual delivery transaction, if he suffers a loss, market price falls down, he suffers a loss, then in the derivative segment he will make a gain, and vice versa. In actual delivery, if he has sold and now there is a loss, then in such situation in the derivative market, derivative segment or for intraday segment, he will make a profit. Same thing for second point, contract in respect of stocks and shares entered into by dealer or investors to guard against the loss in his holdings of stocks and shares through future price fluctuation. To guard against what? To guard against the loss from holding of stock. Holding of stock means actual. So here also what is happening, just like clause A, he has 2 types of transaction. One is actual transaction, one is another is doing opposite direction transaction. That opposite direction transaction will not be considered as a speculative transaction if it is supported by actual transaction of actual delivery or actual purchase or actual sale where delivery is involved. Same way clause C, contract entered into by a member of forward market or a member of stock exchange, that is share broker or the broker on forward market, in the course of any transaction in the nature of jobbing or arbitrage to guard against the loss which may arise in the ordinary course of his business as such member. So in all the first three clauses, clause A, B and C, what is happening is assessee, whether in forward market or stock market or for normal commodity, in all the 3 segments he has actual transaction also of actual purchase or actual sale whereby he is going to receive actual delivery or he has to give actual delivery, and then on the other hand he is entering into opposite direction transaction in a derivative segment, then it will not be considered as a speculative transaction. Same way normal derivative transaction in stock exchange, recognized stock exchange, will also not be considered as a speculative transaction, and same way commodity derivative transaction. So clause D and clause E are same only difference is in clause D we are talking about derivative transaction in case of stock market, and clause E we are talking about derivative transactions with regards to commodity, tea, coffee, rubber, gold, silver, etc. Then if they are eligible transactions, that means supported by bill with contract note, assessee's PAN number and unique identification number is mentioned in that, the time stamp is there, the date is mentioned, the time of transaction is mentioned, signature is there, etc., then it will be called as an eligible transaction. Eligible transaction in respect of trading in derivatives carried out at a recognized stock exchange, or eligible transaction in respect of trading in commodity derivatives carried out in a recognized stock exchange which is chargeable to CTT, commodities transaction tax, except for agricultural commodity derivative where condition of CTT does not apply. These 2 are normal derivative transaction where both the transaction buying selling both are derivative. Then in such situation also in the first 3 clauses what was happening is one transaction is in a derivative market, selling is done in a derivative, then in the actual segment there is a purchase, or vice versa, actually there is a sale, then in derivative assessee will purchase. And here in clause number D and E what is happening, buying selling both are in the nature of derivative transaction. Next is WDV, speculative transaction is over. WDV for depreciable asset. So 43(1) defines actual cost for the first year in case 43(1) will apply for two situations. Either it will apply to a non-depreciable asset, or it will apply to first year, apply to actual cost will apply to first year in which asset is acquired, whereas 43(6) will apply to depreciable asset from second year onwards. Will apply to depreciable asset from second year onwards. So 43(6) has got three subclauses, clause or subclause A, subclause B, subclause C. Subclause A, in case of asset which is newly acquired during the year, the WDV will be equal to actual cost. If newly acquired, then WDV will be equal to actual cost, and actual cost is defined already in 43(1), purchase price plus incidental expense. Clause B, in case it is asset not acquired during the current year or acquired before the current year, then WDV will be equal to actual cost minus depreciation actually allowed to the assessee. And clause C talks about in case asset is forming part of block of asset, then formula opening WDV plus purchases minus sales. Sales is not called as sale, it is called money payable, which is the technical term. Opening plus purchase minus sale. Purchases are not called as purchases, it is called as cost of acquiring new asset falling within the block acquired during the year, and minus sale proceeds is called as money payable. Instead of sale proceeds, we will call it as money payable, that is selling price only of any asset which is forming part of this block, which is sold, discarded, demolished, destroyed during the previous year, along with scrap value. In case money payable will include scrap value also in case you are scrapping the asset. Opening plus purchase minus sales will give you WDV for that particular year. Now this WDV concept has got 10 explanations, almost resembling with whatever we discussed in actual cost. Quickly glancing through: block of asset transferred by predecessor to successor, predecessor transferring to successor in case of business reorganization or succession, sole proprietary concern becoming company, partnership firm getting converted to company, then partnership firm is a predecessor and company is a successor. Asset transferred by partnership firm to company in the hands of company, WDV for the successor company will be equal to WDV in the hands of predecessor as if succession has not taken place. Whatever would have been the WDV in the hands of predecessor, same will become WDV in the hands of successor. Second explanation: block of assets transferred by either holding to subsidiary or vice versa, subsidiary to holding, provided conditions given in capital gain chapter in section 47 clause 4 or 47 clause 5 are satisfied. That is to say, it's a 100% wholly owned subsidiary, WOS, or asset transferred by amalgamating company to amalgamated company. Explanation 2 has a slightly different point as compared to all other explanation, therefore focus more upon it. Then in that case, we have to find out, see, holding to subsidiary and subsidiary to holding, holding company transferring to subsidiary, holding company had acquired for 100 lakhs, depreciation already charged up till now is 80 lakh rupees, and now the WDV, this is closing WDV of last year, becomes opening WDV of the current year, opening WDV as on 1st April. Without charging depreciation for the current year, same 20 lakh becomes the actual cost in the hands of, simply whatever was the WDV to the predecessor, same becomes the actual cost or same becomes the WDV in the hands of successor. This is applicable in case of holding to subsidiary, subsidiary to holding, or amalgamating company to amalgamated company. WDV for the recipient transferee company will be equal to opening WDV of the block and not the WDV as on the date of transfer. This point is only for this particular explanation, opening WDV, and not the WDV as on the date of transfer. Barring this, everywhere we have to take WDV as on the date of transfer. WDV as on the date of transfer, as on the date of conversion, as on the date of transfer. In the hands of transferor company, as if transfer had not taken place. Explanation 2A, 2B, demerger applies in case of demerger. After demerger, what will be the WDV of the given asset in the hands of resulting company, and what will be the WDV in the hands of demerged company. So for demerged company we will calculate later. For demerged company it will be closing figure, balancing figure, where you mainly calculate it for resulting company. Say demerged company has a block of asset which has got 5 assets. Out of 5 assets in the hands of demerged company, 5 assets with WDV 50 crore. 50 crore. Out of 5 assets, 3 assets are retained by demerged company and 2 assets are transferred to resulting company. Then first you find out WDV of these 2 assets in the hands of resulting company. Say WDV works out to be 18 crore. This is step number 1. First you find out 18 crore in the hands of demerged company with 3 assets. WDV of the block will be opening WDV, that is 50 crore minus 18 crore, whatever is the WDV of the assets transferred to resulting company. Balance 32 crore will be the WDV of these remaining 3 assets in the hands of demerged company. WDV for demerged company, before that we need to find out WDV in the hands of resulting company. WDV for resulting company will be actual WDV of such assets in the hands of demerged company immediately before demerger or as on the date of demerger. Whatever is the WDV in the hands of predecessor as on the date of demerger, same WDV will be continued for those 2 assets which are transferred to resulting company. WDV of those 2 assets will be same as whatever would have been the independent WDV in the hands of demerged company. And then when we come to calculating WDV for demerged company, start with the opening WDV 50 crore rupees minus WDV of the assets transferred to resulting company, which is 18 crore. So you calculate practically for resulting company. For demerged company, it will be the balancing figure 50 crore minus 18 crore. In our example, 32 crore is the balance amount. Okay. Now everywhere we have to take WDV as on the date of conversion, transfer, etc., except in case of explanation number 2, holding to subsidiary or vice versa, or amalgamating company to amalgamated company. Barring this, everywhere we have to take WDV as on the date of conversion, as on the date of transfer. Only at this place we have to start with opening WDV and not the WDV as on the date of conversion. Explanation 2C, private company or unlisted company becoming LLP, getting converted into LLP. Private company can be converted into an LLP by fulfilling the conditions given in section 47 clause 13B of capital gain chapter. What is it? We will discuss in capital gain chapters video. Will be equal to WDV for LLP will be equal to WDV in the hands of private company or unlisted company as on the date of conversion. Everything will be as on the date of transaction. Unabsorbed depreciation not allowed to be carried forward will be deemed to be depreciation actually allowed. What does this mean? Let's try to understand unabsorbed depreciation. So for example, my profit for the current year before depreciation, is 100 lakhs and I have depreciation for the current year. Opening WDV was 1000 lakhs, opening WDV. Now minus depreciation. So depreciation for the current year, say it is plant and machinery, current year depreciation is 150 lakh, that is 15% of 1000 lakh, 150, but I can't claim full depreciation, I don't have sufficient profits allowable, so 50 lakh will be called as unabsorbed depreciation, which is to be carried forward to the next year, 50 lakh rupees. So now technically speaking, how much depreciation I have actually claimed? I have claimed only to the tune of profit available. I have claimed only to the tune of 100 lakhs. 50 lakhs is getting carried forward under section 32(2) for unlimited period. However, explanation 6 says that, explanation 3 says that the unabsorbed depreciation of 50 lakhs in this example will also be deemed to be depreciation allowed. So depreciation allowed is 150. When you are calculating WDV, we need to subtract full 150. And the WDV for next year will come down to 850 lakhs. Unabsorbed depreciation allowed to be carried forward will also be deemed to be depreciation claimed and allowed. Fourth point is unimportant, fourth clause, monies payable shall have the same meaning as given in 41(4), which is nothing but money receivable. Though the language should be money receivable, government has used the language monies payable. Similar kind of language is used in TDS chapter also. Though the TDS chapter is from the perspective of payer, then also the language at certain places is drafted in such a way as if the as if the given point is applicable not to the payer but to the payee. Block of asset transferred by recognized stock exchange to the company in a scheme of corporatization. Assets are transferred by recognized stock exchange to, we already discussed this point in 43.1, but in 43.1 we defined actual cost. Situation was same, here same situation is repeated. For company, WDV will be equal to WDV in the hands of recognized stock exchange, which is AOP, immediately before such transfer. Everywhere we have to take into account WDV as on the date of transfer or as on the date of conversion, except at one place, explanation 2, holding to subsidiary or subsidiary to holding or amalgamating company to amalgamated company. Here we have to consider WDV, which will be opening WDV and not the WDV as on the date of conversion. This is the only off the track point. Rest all, it is very clear that it should be WDV as on the date of something happening. If assessee was not required to compute his total income for any earlier year, maybe earlier years assessee was covered by 40 for AD, 40 for ADA, presumptive taxation, where depreciation was not allowed separately, then WDV will be equal to actual cost minus notional depreciation till now, as if depreciation was claimed and allowed. The last one, income of the assessee comprises partly of agricultural income, which is not chargeable to tax, and partly of business income, which is chargeable to tax, whereby some part of the depreciation is allowable, whatever pertains to business income, taxable income, that much depreciation is allowed, and part of the income and part of the depreciation which pertains to that much part of the income which is not chargeable to tax, that much is disallowable. For example, tea business 60-40 ratio is followed. 60% is agricultural income eligible for exemption and 40% is taxable. Then in such situation, or you can take example of coffee and rubber also, then in such situation, out of total depreciation, say total depreciation is 80 lakh rupees, out of 80 lakh, 48 lakh pertains to non-specified, 48 pertains to exempt income, or not non-specified but exempt income, and 40% pertains to taxable component, which is 80 lakhs into 40%, 32 lakhs. So out of total depreciation of 80 lakh, this much is allowed because corresponding income is taxable, and this much will be disallowed, it will lapse. However, when I compute WDV, for WDV purpose, I have to take depreciation to be full 80 lakhs. So from WDV I will subtract 80 lakh, though this 48 is not allowed to be claimed, will be deemed to have been claimed. Income of the assessee comprises partly of agricultural income which is not taxable and partly of business income, whereby part of the depreciation will be disallowed and any part and some part will be allowed. Total depreciation computed in respect of the entire income derived from business only, and WDV shall be computed accordingly as if the entire depreciation was allowed to the assessee. This is unimportant. Question has come, but it is unimportant. That's it. With that, this chapter comes to an end. Thank you very much. See you in the next video with the revision of some other chapter. Till then, wish you all a very good luck. All the best.